Have you ever been convinced the market would crash on bad news only to watch it rally instead? Here's what happened in October 2025. The US government shut down, federal workers went unpaid, services halted. All that sounds bearish, right? Well, the market rallied 115 points. So why do markets ignore news that seems catastrophic? And more importantly, how can traders distinguish between narratives that actually matters and market distractions? Today, I'll walk you through a framework for analyzing which news tend to move markets and which headlines turn out to be irrelevant. Now, quick disclaimer before we dive in, this is educational content based on historical market observations. Trading involves substantial risks, including the risk of losing more than your initial deposits. And this is not financial advice. Alright, let's get into it. So when the shutdown hit at midnight, the market dropped sharply to 60.80. 2 hours later, it reversed, and by the time most traders woke up, it was back at 60.69 and climbing. Now I shorted the MES futures contract here, expecting fundamentals to matter. But the market had other plans. Here's what many traders miss. Markets don't weigh every narrative equally. They create hierarchies. Think of it as 3 tiers. Tier 1. Central bank policy reaction to economic data. Fed rate decisions. Quantitative tightening and easing. Inflation data. Employment numbers that move Fed policy. These tend to drive markets most consistently. Why? They affect the cost of capital everywhere. Tier 2. Fundamentals, corporate profits, GDP, consumer spending. These matter, but here's the catch. They're filtered through Tier 1. Strong earnings can be bearish if they mean higher rates ahead. Tier 3. Geopolitical and political events, trade wars, elections, shutdowns. These can move markets, but they typically matter most when they threaten tiers 1 or 2 or are hugely unexpected. Here's the key observation. When narratives conflict, tier 1 has historically carried more weight, not always, but the pattern appears frequently in market history. While the shutdown dominated headlines, that's tier 3, the market had already moved past that. It was processing tier 1 information. You see, that morning, ADP employment showed a loss of 32,000 jobs. Weak data, right? But the market interpreted it through a Fed lens. Weaker economy might mean faster rate cuts. Here's the logic chain. Weak jobs suggest a soft economy. A soft economy could push the Fed toward cuts. And lower rates tend to support equity valuations. So bad economic news actually became bullish in this context. The shutdown possibly already priced in. Now, one more factor here, the trend. Back on August 1st, the market was at 62.96. By October, 67.79. That's 483 points in just 2 months. And when momentum is this strong, historical patterns suggest it often takes tier 1 bearish news to break it. Tier 3 events rarely stop established trends, though there are exceptions of course. And get this, the week before the shutdown, the market rallied 70 points. So the price action was already signaling this particular news doesn't appear to matter to current pricing. Fast forward to mid-October, Trump announces tariffs on China starting November 1st. 100% tariffs. The market sold off sharply. Wait, didn't we just say tier 3 events, geopolitical news rarely moved markets? Here's what changed. The market initially treated it as tier 1 relevant. Remember, tier 1 is Fed policy and economic data. Tariffs here could mean higher inflation, which could keep the Fed from cutting rates. So this tier 3 geopolitical event was threatening rates. That's what gets attention. But if we look at 3 trading days later, the market is already rallying back. That's because Trump softened his tone and the market decided this isn't the tier 1 threat it initially appeared to be. Markets don't trade pure logic, or as Benjamin Graham said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Now, price reflects actual capital deployment. Analysis reflects interpretation. Here's the bottom line. Next time a major headline breaks, ask yourself what tier is this and what's tier 1 saying? That question has changed how I analyze shutdowns, trade wars, and elections. Want to practice this framework without risking real capital? I've put a link to ProRealTime's free trading simulator in the description. Build experience before putting real money on the line. Because understanding what the market is prioritizing, that can matter way more than being fundamentally correct at the wrong time.